Good morning, respected dignitaries, chief risk officers, chief financial officers, senior executives, our knowledge partners, and esteemed participants. It is a great honor for me, Mukti Pansare, from the Indian Banks Association, to welcome you all to today's event, Decoding the proposed ECL regulations for banks and financial institutions. As you are aware, the Reserve Bank of India issued the draft ECL directions on 7th October 2025, ushering in a fundamental shift from the current incurred loss model to a forward-looking provisioning framework, effective April 1st, 2027. Today's seminar brings together experts, knowledge partners, and industry leaders to understand this transition, its implications, and the pathways ahead. To begin today's proceedings, it is my privilege to invite Shri Gopal Murli Bhagat, Deputy Chief Executive, Indian Banks Association, to deliver the welcome address. Over to you, sir.
On behalf of Indian Banks Association, I extend warm welcome to you. And in the beginning itself, I thank all of you for participating in this seminar. When this subject was discussed in the managing committee of IBA, the reaction from the chairman, IBA, Shri Sethi Sahab, was that this is a subject that needs a bit of hand-holding, discussions at the industry level, to understand the implications in the beginning itself, so that when it comes to actual implementation and declaring balance sheets based on ECL, the industry should be aligned, should have uniform understanding of the subject and the practices. This is from that perspective that we have arranged this seminar. And three major consultants in the country are here today to discuss this subject with all of us and guide us. I'm very happy to say that Mr. Banerjee, who was part of the committee which was deliberating at the regulators and on ECL, is also here with us today, and he is going to share his experience and the understanding of the subject or the challenges which he faced, being a member of the committee there. These things will be very enlightening and will get a good way forward. Friends, in the beginning itself, I would like to place thanks to the managing committee and thanks to our chief executive, Shri Atul Kumar Goyalji, who is here today with us, for encouraging us to arrange such kinds of seminars and webinars, which are very beneficial to the entire industry. And the benefit of coming together and discussing on subjects is really immense. We have seen the benefits in the past. So once again, thanks to all of you, thanks to our chief executive, Shri Goyal Sahab, and thanks to all the speakers also who will come here today. We'll keep on thanking them simultaneously. But to begin with, I will say big thanks to them also. They are giving us good time for deliberations. And a bit of request to all of you, please participate. It should be an interactive session. Certain things, which we take for granted that we know this is a meaning, may not be the real meaning, because now these terms are used as technical terms. So I remember when we were discussing, our Jayashankarji, our senior advisor for corporate credit, who is the key person for arranging this seminar, he has taken all the pains. So we were discussing what is the, initial recognition. First word, I think, in the circular, which really, we got stuck, what do we mean by initial recognition? I hope Mr. Banerjee will throw some light on this also. So not of much time, and thank you very much once again. Thank you, Mukti. Wish you all will enjoy this seminar and will really be more knowledgeable, and when we go back, we'll be more enlightened with the subject. Thank you. Thank you very much.
Thank you very much, sir. We now move on to the keynote address. It is my honor to invite Shri A.K. Goel, Chief Executive, Indian Banks Association, to share his perspectives and formally set the context for today's seminar.
Thank you very much, Mukti. Very good morning to all. Really, it is a proud privilege for me. It is a great opportunity for me. Rather, it is a honor for me in welcoming all of you for the two-day seminar dedicated for the proposed ECL regulation. And you all will be aware, this is a very important topic because we were talking from the ECL last 4 or 5 years when it will going to be implemented. So now already the guidance is there. So once again, on my personal behalf as well the behalf of the IBA, I welcome all the participants. I welcome all the speakers. I welcome all the panelists for the today's deliberation. As Mr. Bhagat has already told, we have called very knowledgeable speaker for the today's session because it is a very important subject which will change the balance sheet of the all the scheduled commercial bank also, because the provisioning requirement based on the which type of the assets you are having. That is the main purpose of the ECL also. So as Mr. Bhagat has already told, Mr. Banerjee, who is from the KPMG, I understand he was the part of this committee also in the regulator side. So he will having the in-head experience. So definitely we all will be benefited with his knowledge level also. And as friends, you all are aware, the 7th October 2025 was the date when the regulator has issued the circular for the ECL, and after that they have also issued one of the more circular related to the credit risk allocation also. The main purpose will be today's deliberation will be ECL, although we will also little bit touch about the how to allocate the credit risk. Little bit that will be the today's deliberation also. And you all are aware that this ECL, because it was a talk from the since long, whether it will be implemented, even when I was the MD of the 2-3 banks. So the media person is asking, sir, when the ECL will be implemented? You should ask from the regulator when they will implement. And now the date has already come from the 1st of the April 2027, date has already been given. So now the responsibility, all the participants, we should make ready ourselves also. Because implementation ECL is not an easy task. The calculation part is something different. But for the calculation of the ECL, etc. also, because I was the part of the some discussion also, you need to change your IT system. Because there is a terminology also, the effective rate of interest. Effective rate interest means ki whatever the processing fees you are getting, that you are crediting your provisions upfront basis. But in the ECL, effective rate of interest, it has to be abortion also. Suppose you are giving the 5-year loan, you are charging the processing fees, so it has to be abortion for the 5 years. So there is a need for the change of the IT system also. So this will be there will be a challenge also for implementation, but I think with the help of all the member also and the guidance from the speakers and the panelists, and we have also seen the challenges in the past also, when even the IFRS also, when I was scared to whether it will be implemented. So whatever the guidelines of the regulator and whatever the timeline they have given, always we have complied the guidelines of the regulator. So I am sure this time also we will be in a position, whatever the timeline has been given, even more than 1 year is available to us. More than 1 year is available for us. Even we have to see whether we have to give the impact, that we will take the clarity from the regulator also. Suppose it is implemented from the 1st of the April 2027. So Mr. Banerjee, please give if you have the whether we have to give the effect for the 26 also balance sheet also. So we have to make the back calculation up to 26 March. It will not be mandatory, but when we will publishing the result of this 27-28, whether we are required to make the amendment in the last year balance sheet also. So this type of the question will be coming for the deliberation also. Whatever you are having in mind also, please give your suggestion or the whatever doubt you are having. So because time is available. From the IBA side, I can assure you, we can take up the matter with the regulator also, where we are thinking there is a difference of opinion also. And the purpose of this today's seminar also, because the ECL, there may be a different, this is a talk from the long times, there will be a different method of the calculation by the different bank. As a IBA, we wish, we desire there should be a same set of implementation from all the public sector banks. So that can also be deliberated if there is a challenge in the implementation also. So maybe after consensus with all the members, then we will discuss in our MCBSR. We can issue the guidelines also. This should be the framework for the calculation, etc. Also, that is also a very important topic for the today's discussion also. And as you all are aware, as on the based whatever the provision we are making, it is not we are not making the provision. As on date also we are making the provision, but that is based on the incurred loss. Incurred loss, when you are classifying the account to the NPA standard, to substandard, you are making 15%, then it is turning to the doubtful 25%, then D2 40%, and this another 60%, 100% you have to make to D3. The purpose of the ECL, now you have to make the provision for the entire portfolio. That is the change, because incurred to the based on the PD, based on the LGD, exposure of default, etc. Then you have to see the stage 1 and stage 2, etc. Then you have to make the calculation accordingly. So the responsibility of the, because we have called all the CROs and the CFOs also, because balance sheet is being done by the CFOs also. This was the reason for such type of the deliberation, we are calling both the person. So there should be a coordination between the risk management, because they will be make the solution, etc. also for the calculation, and the CFO has to give the impact in the balance sheet also. So both should be on the same line. This is the reason we have called for in the earlier discussion also, the CFO as well as the CROs also. And most important, one of the also aspect is this, I think you have to change your mindset from the CRO point of view, which type of the risk you are taking. The balance sheet of the bank in the future will be determined which type of the credit risk you are taking, because this ECL is based on the which type of the quality of your portfolio. As I told you, stage 1, stage 2, you have to make, even for the stage 3. Stage 3, as on date, the RBI has given the guidance that it has to be calculated based on the product type as well as the duration of the default. So that is also will be the today's discussion also. And I think as I told, Magaji has all told, there is a partner from the today's discussion from the KPMG, as I told, Mr. Banerjee is there. We have also called from the Deloitte also, and we have also called from the Gartner also. So once again, my best wishes to all of you for your today's deliberation, and my request, please be interactive. Whatever your doubt in your mind, please feel free to discuss among the today's team also. And I assure from the IBA side, whatever the action point which we will be pointed out today, there is not clarity in this, we are taking from the regulator also, because they are very receptive. Both the side, I can say from this forum also, regulator, they are also hearing the IBA, even the government is also hearing the IBA properly also. So whatever the doubt in your mind, please feel free for the discussion also. And seminar today, it is just a beginning of an ongoing discussion on the proposed ECL, and this is the first we are having, even the future also, because as I told you, 1st April 27 is the date of implementation, also more than 1 year is available. Even we will be required to have such type of the more meaningful seminar in times to come also. So as I told you, I invite your feedback, I invite your suggestion also. With this, once again, my best wishes to all of you for the today's deliberation. And from the IBA side, I extend again my warm welcome to all of you, because we have called you at a very short notice, and in the participation which I am seeing, we have got the nomination from all the member bank around 80 also, and the same type of the 75, between the 75-80, we are already seeing the attendee also. So once again, my thank to all of you for the very short time you have attended this. So thank you, all the best to you.
Thank you very much for setting the context for the day, sir. We now move on to our first presentation, which will be led by KPMG. This presentation will provide an update on RBI's draft circular on expected credit loss and model risk management, along with insights on how these provisions interplay with the credit risk standardized approach guidance. May I invite Mr. Rajosik Banerjee from the KPMG to begin the presentation, please.
Thank you for the opportunity to speak today. While we would want to take credit being a part of the committee, I'm not the only one in the committee in this room. By the way, there are some people sitting in that corner. So Sushanta, if you may want to raise your hand, So by the way, Shushanto was representing HDFC Bank then, and he now has moved to a foreign bank. So he will then deal with nuances of a SEC registrant as well as a foreign filer. We also have Vasu, I think he's going to be joining in the course of the day. I don't know if he's here. So he's from ICICI. So we had we have got Vasu. I think all our committee members are sitting behind. So you know where to ask the questions so that we have the context in here. So now what we will aim to do in my session is we'll talk about 2-3 things. One is with respect to this whole ECL and like sir mentioned, what does it mean? What has been the deliberation and what has been the calibration done by RBL? So we don't take every credit to what has been published so that I'm clear in terms of the expectation. I'm good, that's okay. The second is also embedded in this circular that came about, and what, by the way, we call it as Oktoberfest. 1st October, monetary policy happened. 7th October, the announcement happened, and we came with 3 circulars, 2 circular with 1 embedded circular. Credit risk, standardized approach, ECL, and model risk management. So this were the 3 that came in. And what followed was a lot of action that happened in the market. So what we'll therefore aim to do is try and find out what the interplays are, and maybe we'll do some anecdotal reference on some element of the deliberation that we can publicly disclose, and how does it all pan about. So as we sort of look into this whole ECL circular, first and foremost, let me just call out from an RBI point of view, and I think they have made it amply clear they're not calling it as an IFRS/Ind AS transition, so that we are clear. So which effectively means that April of 2024, we had the investment circular that came in. 7th of October, the ECL circular got published, which is going to be effective 2027. By the way, when we look at the financial instrument standard, there are also pieces on derecognition and hedge accounting, and there could very well be a possibility on those coming as well. So please be mindful that IFRS 9, while it is not being called IFRS 9 and it is called IRAC 2.0, is going to come. Plus, we'll have the other paraphernalia coming in. The good news is, yes, it will hopefully come in pieces. The bad news is, because of the thing coming in bits and pieces, the application is slightly more diverse, and therefore the interplay, like we heard sir speak earlier, that we have this element of financial asset suddenly being defined. We have this element of initial recognition and subsequent measurement coming in. And here is the news. We have this whole element of business model definition in the investment circular, and it brought in this concept of SPPI, solely payment of principal and interest. However, this is not in the circular. So therefore, one could possibly argue that loans will never be having this application of FVOCI or fair value through other comprehensive income. That could be one stand. The other stand is, please refer back to the investment circular, because if your business model is to do syndication, risk participation, and sell-off, then clearly that will not be held to collect contractual cash flows, and hence that will not meet your amortized cost as a definition. However, ECL will be applicable. So just again be mindful of that fact. Now, the reason I just call out that this is not completely aligned with IFRS is because the sheer fact that we have now brought in this element of floors. And by the way, we have been sort of working back with the likes of IBA and CAFRAL in getting some of the information, and we have been participating with some of us in this room. We already know that. To say what is it that we want and what do we want clarification. And I can tell you the most popular clarification, and tell me if somebody disagrees with me, is on the floor, especially on stage 2. In fact, Sugata was telling me earlier that why is it not stage 1? That's a different story. But stage 2, 5% seems to be a highly debated conversation. If truth be told, how many of us have really calculated the number? I will be a little circumspect here, because some of us have calculated with 25 assumptions and not 25 models. So I think we need to be mindful of that. So first thing first, IFRS/IRAC 2.0 is ECL plus the floor, which is where the departure comes in. Now here becomes important, and we have got a few registrants in here. I mean, one, banks who are reporting under foreign GAAP, which could be IFRS or US GAAP. Banks having NBFCs who are embedded in that, who are already reporting under IFRS, and the financial institution themselves. So let's break the conversation in that part. One who are doing US GAAP reporting, the concept of CECL is there and ECL is not there, which means there's a concept of lifetime loss, and therefore we don't have the concept of SICR, significant increase in credit risk, as a conversation that is going to be there. So that becomes an important consideration. Similarly, again, a highly debated discussion around probability weighted outcomes. So when you compute your ECL, you have to do a probability weighted outcome, which should be unbiased, 3 case scenarios that's going to be there. Again, that's going to be a departure. So that's for the US registrant or US GAAP registrant. Then comes one who are reporting under IFRS. And we've got a lot of the foreign banks who are reporting under IFRS. And I know Nara and I, we were discussing the other day that, while we are doing IFRS reporting, but we are doing IFRS as per the group models. We are not doing IFRS as per the Indian models. Therefore, there would be that onus on all of our foreign banks also to build calibrator models which should be suited for India. And I can tell you, we have had about 20 deliberations in RBI, if not more. And the idea was to talk to all participants, which is whether it was a bank, whether it was an NBFC, whether it was a rating agency, whether it was auditors, to understand what it means. And clearly, those departures will warrant us to relook at that element of the recomputation that needs to be done. So US GAAP, IFRS registrants for foreign reporting, if it is not calibrated, needs to be done. Then comes another unique nuances with respect to entities, which is the parent company is a bank and the subsidiary is a NBFC. So there's this whole concept of fit for consolidation. What do I do for consolidation purposes? And the question that comes about here is, NBFCs were already doing the reporting under IFRS. Here is a new set of rules that has been given for banks. And come the auditors, they will say, okay, I would want to see alignment in the methodology. How does one deal with that? So I think the reason I'm just calling out these nuances is because with series of participation, both with the regulator and with the regulated over these years, I see those things needs to be addressed. Now, let me come to the specific nuances with respect to the ECL discussion and some things that we need to be taking home as a conversation, which I'm sure most of us are doing, but we need to be slightly mindful of it. First thing first is the whole definition in itself. And there are 2 definitions that one needs to be mindful of. One is this definition of default and this other definition of SICR. Now, by natural revert, our definition of default is going to be 90 days, which has been the natural answer. But if you see RBI's circular or draft circular, they have actually defined NPA, that they have not used the word default, they've used the word NPA. And they've brought in quite a few definitions within the word NPA. They brought in cross defaults, restructuring, and others. Now that becomes a very, very, very important parameter for us to consider, because what I define as a part of my policy as default definition is what needs to be also calibrated for all the data in the past. And by the way, aligned to what has happened for Basel and IFRS and IRB in the Europe, you have to capture one economic life cycle. So what RBI has called out as a part of this paper is said at least 5 years of economic data has to be captured, which means historical 5-year data. Now, if you have a definition of default being cross default, group default, restructuring, and 90 days past due, then you have to perhaps go back in the past to make sure that that is consistent, because every migration that you do in the past, say for 23 moving to 24, 21 moving to 22, and so forth, has to be also consistent. Otherwise, you'll be having a apples to pineapples comparison. Likewise will be this whole definition of SICR. And by the way, there is a very interesting question somebody asked me a couple of days back. If you look at Appendix 1 of the circular, RBI has given illustrative list saying that definition of SICR, which is significant increase in credit risk, has elements of 30 days past due. It has elements of EWS. It has elements of credit risk notching, so risk rating notching. You could have standard deviation movement. So they've given a fair illustrative list. Now the question is intent versus content. Now what I mean by intent and content, the DOR has published this. And here comes the SSM 3 years later and says, okay, RBI's illustrative is actually not illustrative, it is mandatory. So therefore, there is also going to be that level of alignment that RBI also has to do at their end to make sure that between DOR and DOS, or even at the SSM level, what has been meant is what has been translated. And I can tell you for a fact, this alignment is already happening as we speak, whether it is using costs, whether it is using CAFRAL, and maybe using IB also to make sure that alignment happens. But coming back to us in this room, we need to therefore make sure that this element of SICR needs to be taken care and decided upfront, because that will then decide what is going to be my triggers associated to it. Few things that needs to be also considered is, like I mentioned, RBI has called out that there's this forward-looking indicators needs to be done, which effectively means that something like an EWS. There is already an EWS circular that is in play. So therefore, we need to make sure that, and EWS, they're talking about led due to credit events and other events. How does that dovetail into my overall framework when we are bringing in? And how do we make sure that the two are not misaligned? And we are seeing some element of misalignment coming in there. So that would be one that needs to come in. In some cases also, and this is maybe for the slightly sophisticated bank, they are also putting SICR trigger as saying cumulative change in my lifetime PD, and if it goes beyond a certain credit threshold, that will also be an SICR trigger. So then we need to be mindful of how do we want to bring that forward-looking piece in. One question which is not negotiable according to me, and maybe Vasu, and Vasu is by the way doing the panel, so you should have some questions for Vasu also at the end, is with respect to the cooling off period. And this whole thing is, if something moves to stage 3, can that be allowed to be cooled off earlier? And there is a 6-month cooling off, and it says that if the account becomes regular, it has to be regular for 6 months period. And by the way, this is broadly aligned with global practices also. So if you ask the foreign banks in the room, you'd find many, if not most of them, are having 6 months or higher in terms of the cooling off period, i.e. therefore rolling back from a stage 3 to stage 1. What are the implications thereof? Lifetime losses can remove or revert back to 12-month loss after a 6-month period cooling off. So that's with respect to the overall computation with respect to the SICR. Now, what remains to be discussed here also is what we call a segmentation. And what I mean by segmentation is you would have your wholesale book, you'll have your retail book, and wholesale book will have different types of underwriting that you would do to large corporates, to MSMEs, to SMEs. Now, the question that comes in is, we have to create homogeneous pools of similar risk characteristics. That's what the standard requires. And by the way, the regulator has also copied the same thing. And then they've gone ahead to define what possibly could be those pools / segmentation one would need to do, because that will essentially determine how does the calculation happen for EAD, how does the calculation happen for PD, and the LGDs associated to it. And therefore, it becomes imperative for us to make sure that we have that level of homogeneity tests being done upfront, the homogeneous pools being looked at, and therefore the data cohorts build out also happening in that particular manner. Which therefore, if you go back to the RBI thing, it goes on to saying it could be by product, it could be by segment, it could be by, if it is a mortgage thing, it could be by LTVs and vintages also. We need to have as much of disaggregation also in our own interest, because if it is aggregated, you will perhaps not be able to build any relationship, statistical or otherwise. And second, you will get spurious answers, because one of the things that we are getting as a response, and we've been working with some of the upper tier NBFCs right now who are doing capital market transactions, is where their observed default is 2%, but a 1-year default is 22%. Now that intuitively is not making sense. So how do we try and bring some element of method to the madness? And it can only come with that level of disaggregation in the portfolio of similar homogeneous risk characteristics. One can possibly say that, oh, as the large bank, I am taking as large exposure as one pool, and that's how I do it, and therefore I would want to continue to do it. But please be mindful that your nuance of infra versus a power versus a real estate will not remain to be the same. And hence, you may want to get that level of disaggregation upfront that's going to be there. So therefore, what it brings me to the next thing is, depending on the segmentation which becomes paramount, you then determine your migrations that needs to be built in. And then depending on the type of migration that happens, which means that you will have default, you will have no default, you'll have no default, and you'll have newer portfolios to begin with. You'll have all of this combination that will happen. You'll have to then appropriately fit in your modeling techniques. I mean, obviously one of the most abused word in the Indian context is, I'm using a Vasi-check model. Ask any third NBFC in the street, they'll say, I'll use a Vasi-check model. Please, please, please use a right model. And maybe, I consider Sugoto as one of the, brighter brains in the room. So please, you can refer to him. Maybe Sugata, you can give your classes after that also, to get the right methodology in terms of the computation that needs to be done. So for a no default portfolio, there are different methodologies. You can use a Pluto Tash or a Forrester approach. For continuous homogeneous, there are different methodologies. A discontinuous homogeneous, a different methodology in terms of the data. So you'll apply a Markov chain, you will have a VBOOL, you'll have different methodologies that one would need to apply, right? And then comes this whole story around applying for newer portfolios where I started underwriting now. And or I would have portfolios where I have not experienced default to, because the duration is not passed in. Then you have to build some kind of an expert judgment model. How do you build that expert judgment model? How do you rely on, say, an S&P or a CRISIL 15-year migration, calibrate to your portfolio? So that becomes a very important component in the modeling aspect. I think one thing that, as RBI has published, and I think we may just want to be slightly careful about it, RBI did permit an element of using your own behavioral models, whether it is on account of your CCF, whether it is on account of prepayment, whether it is on account of revolving facility, tenors that is associated to it. Therefore, it goes back to the fact, or even for that matter, LGD. So we may want to therefore look upon what is the level of information that we have today for us to get to all of this level of computation, for us to get more refinement coming in. I'll tell you, at least being a practitioner, I've seen at least some level of sophistication happen on the PD computation, but where we're seeing a fair amount of challenges on the LGD, where you are not able to track recoveries against write-offs. By the way, you have to define your write-off policy. And there are a lot of organizations, we've been interacting, there's this whole thing around technical write-off versus a write-off. How do I deal with that? So please have this write-off policy documented. And I know for a part of the thematic review, some banks have been picked up to ask that, okay, define what a write-off policy is. And that will also have an implication on how this whole migration per se looks like. And after you're written off, then what you collect will effectively then come straight to your whole computation. So you'll have to look at all of that. Few things I'm slightly worried, and maybe it'll unfold as we sort of get going on this one. One is there are rebuttable presumptions that has been called out. So there is a 30-day rebuttable presumption that has been called out, and it has been said that if you are able to demonstrate by data, you can rebut your 30 days. By the way, just to put some context in place, even a larger part of the Eurozone, whether it is Germany or Swiss or UK, in many or most of them, while the rebuttal provision was there in IFRS 9, that has not been applied. So people still have been 30 days. In some cases, they have been more stringent, but not relaxed. But the moment you open up a rebuttable presumption relaxation, you would find a tendency to move the other way around, where you'll find 89, they could be stage 1, and 90th, they suddenly become stage 3. So you just be mindful about it. Are there methodologies to deal with it? Yes, and you can do some element of forward flow, backward flow, stabilization points to get to that. But in my personal view, I think that is something that we may need to be very careful should we want to rebut it. And again, having had conversations with the regulator and auditors also, when I mean auditors, my colleagues in audit profession, this is one piece that is going to be superly reviewed. The other piece that has also been opened up for debate is with respect to this whole element of macroeconomic overlay. In fact, this is a very cute conversation I've heard over the years is everything reverts back to the mean. And therefore, why do I do a forward-looking thing? Because eventually everything will come back. But unfortunately, ECL has the word expected and then your credit loss. Then the E is the expectation, and expectation is also a function of your macroeconomic that has to come about, right? So you can't not do macroeconomic and say it is E in the ECL. So that I don't think has been negotiated, but where the relaxation has per se come about is if you're not able to statistically establish a relationship with your portfolio, you could also have an alternative mitigation. I think that's by far a reasonable understanding. But what remains to be there is that we need to figure out where we are pushing the boundary versus where we are not pushing the boundary, so as to speak. So I think that's where I would want to put a bit of a caveat and caution around the computation itself. I'll talk about model risk management subsequently, but one part of the model risk management which becomes relevant to this ECL computation is what we call as post-model adjustment. So there's a reference of PMA that has been coming to this circular. And by the way, this PMA as a concept has been introduced in this paper called SS 123. So this is a paper by the PRA, which is actually a model risk circular, which says that you would have models and you may or may not like the answer of the model. Does it mean that that number happens to be sacrosanct? The answer is no. So you could have a post-model adjustment. However, that post-model adjustment has to be documented, explained, and at times disclosed. So we just need to be mindful about how do we do it. And maybe just let me share a quick anecdote. If you read the ECB supervisory priority letter that got issued about a week back, so ECB publishes their supervisory priority letter, and as part of the priority letter, they have actually called out ECL being one of the priorities and stage 2 computation being another important priority. This is a week back. And by the way, just to call out, most of Eurozone is already moved from a standardized to FIRB, in most of the cases AIRB, advanced IRB approaches. They have already transitioned to IFRS, almost 7-8 years now, yet they're still struggling. So if you're expecting the perfect answer to come in day 0 or day 1, that may not be a thing that happens. So just to call that out. Good news, again, the deliberation, which I think banks benefit, which the NBFC did not do, was whole thing around transition benefit. NBFCs, when they transition from the old gap to the new gap, whatever was the stock of provision, or the incremental stock of provision that was there, that was hitting their net worth, and there was no transition relief. And if you look at the BIS paper that got published during that point in time, in 2014-15, they talked about 2 transition benefits, static transition and dynamic transition. Eventually, Europe moved to this whole concept of static transition, which is a 1/5, 1/5, 1/5, 1/5. So basically, whatever was the old provision, let's assume old provision was 100, new provision was 120. 20 is the new stock of provision, which is hitting your tier 1, tier 2 capital, in effect your CT1 capital. That was being amortized over 5 years time, and therefore there was a capital relief that was there. The good news is that is extended to the banks, which is unfortunately not been extended to the NBFCs at this point in time. So that remains to be there. 2 questions, and like Sir mentioned earlier, which is debated, deliberated, and if I were to be calling out, I don't think we have a resolution until we see the final circular being issued by RBI. What is the real transition date? Because your capital circular transitions on April 27, your ECL circular transitions in April 27, and the modular circular. If you look at the investment circular, which came in April of 2024, which was effective then, it did not ask for a comparative financial statement. And by the way, in India, RBI is the only regulator who does account setting as well as capital setting. If you look at Europe, you have the ISB who does the accounting piece of the work, and then you've got the in-country regulator, PRA, FINMA, BaFin, and others doing that element of capital, and the ECB, so to speak. So the question remains is, what is going to be happening on April 2026, and what happens in June of 2026? And the reason I just call out is, and this, by the way, has been a deliberation that we've had, and there can be 2 versions to the answer, if I may call it out. One version of the answer is, investment circular did not warrant us to do a restatement, and therefore, for my ECL circular, we will not do a restatement. So please bear in mind, what does it mean effectively? It effectively means that for the quarter ended 30th of June 2027, which is the first quarter reporting, we will have a situation that in June 2027, I will have the new numbers as per IRAC 2.0. And if I don't ask for a comparative, it will be IRAC 2.1. It will be apples and pineapples comparison. Is that good enough for the investors? I don't know. Will it create confusion in the market? Maybe. So that could be option 1 if we go the investment circular route. If we go the real transition route, and again the point that got mentioned, is then I will have to have my opening balance sheet drawn up on 1st of April 26, which is 3 months from now, or maybe 4 months from now, if I stretch the argument a little forward. And therefore, for 26-27, I'll have to do a parallel computation, which will not be disclosed to the public, but I still have to do the computation associated to it. And come 30th of June of 2027, I'll have to do prior period numbers. The 2 has significant ramification, because if I go to the latter piece, I have to start essentially my activities now. That's where the bigger conversation comes about. So we just need to be mindful of how do we want to deal with that part of the transition. Few small nuances that I may want to talk about as well is, as we move along, please emphasize on your off-balance sheet exposures, especially around undrawn commitment and financial guarantees. We are seeing a lot of disconnected understanding on that, especially when it comes to UCC clauses in a term sheet, that I've got an unconditionally cancelable clause, and therefore I would want to take the benefit of that and therefore not apply or maybe apply a regulatory. What it effectively says is, while you may have a UCC clause, and just to put some context in the deliberation in ISB that got happened, in ISB deliberation, there was a special group, that task group that was created called the ITG, Impairment Transition Group. And if you look up on their website, Impairment Transition Group actually deliberated on this topic to say that just because you've got an undrawn and you've got a clause associated to it, if risk mitigation action was never taken, then to that extent it will be considered, you'll apply the CCF and it will be considered to be drawn. If risk mitigation action is being taken, then you get the benefit. So again, those pieces we may want to tighten up. So it is not just about getting the models right, it's just getting the right, the data right, but it's also about getting the underwriting right in one shape and form. So I think that's where you may want to sort of look about pieces. Aruna is going to talk about on model risk management, but again, what I thought that may be relevant, because it's just like an embedded derivative in this contract. The model risk circular is also embedded as a part of this thing, and which was a part of the TOR that we had to respond to our RBI. So the reference to the model risk circular is actually reference to the fact that today RBI, as a part of the scrutiny, is already asking questions with respect to saying, you have models, it needs to be validated, and SSMs are raising questions around it. But what is the validation guidelines? The ones who are referring to validation guidelines, they know there is a BCBS paper 14, SR 11.7, or the latest and greatest SS 123. But there is unfortunately very limited anecdotal references that is there. If you look at this circular, while they're not calling out SS 123, which is the PRS circular, which encompasses a lot more pieces around what is a model inventory, what is, we call it as model tiering, to say that is every model important. So you have to say the basis materiality, usage, geography, you can determine those tiering. That will determine what is your validation plan associated to it. So you may therefore want to, so there is a fair amount of guidance that RBI has given. But if you really want to look at reference to the guidelines, you may refer to circulars in my view, Basel paper 14 and SS 123. What the circular is not called out, and by the way, that was a recommendation that we had given to RBI, is to call out what is a validation. And it was funny because when we were doing the outreach, we realized everybody had a different definition of validation. Somebody was looking at homogeneity test and said, my model is validated, but that is not. You effectively, if you're doing credit model validation, you'll have to look at discriminatory power of the model. It is discriminating between good and bad, predictive power of the model, and the accuracy ratios at a minimum. And then each of them has thresholds. Because today, I'm bank A and I decide that my Gini coefficient, which is a threshold that one would need to look at, 60 is a good Gini coefficient. Right? Other bank B is saying my Gini coefficient is 80. Bank C is saying my Gini coefficient is 30. And that will determine, depending on that threshold that I determined, whether my model is passing or failing, or my test is passing or failing. So we just need to look at what is the area under the curve. So we just need to be mindful of what those tests are. So please at least go back to looking at your test that needs to be done. So whether it's a Gini, a Petra, a case, and all of those tests that needs to be there, please refer to those guidelines that I may want to call out. Like I mentioned to you, clear emphasis is there is on the 3 LOD that is there, 3 lines of defense. And sir, I'm happy that we have the CFO and the CRO in the room, because clearly there is a clear underpinning in the circular which calls out the fact that we ought to have a committee of the executives, and specifically calling out the CRO and the CFO and extended RMC and ALCO and other pieces, where this is going to be a committee which will essentially look at this computation, not just for model risk, but also for the ECL pieces. Second, this has to be a board-approved policy. So this therefore means needs to be documented, has to be explained to the board. And I can tell you for a fact today, even independent directors, while they may not be a banking expert and definitely not a modeling expert, are trying to understand this nuances associated to it, because there is a fair amount of implication. And just to give an anecdotal reference, when this whole deliberation was happening in the ISB, there is this whole paper, and not quite often we come together, but I'm happy that they came in together. So there's a GPPC paper. So GPPC paper is basically the big four and the other two, GT and BDO, they came together. And they came up with two papers. And maybe for the banks, I would request you look at that. So GPPC had come with two papers. One, they came saying that what is acceptable in modeling, what is acceptable, permissible, and not acceptable in modeling, what is acceptable, permissible, not acceptable in governance. They actually went quite meticulously to each of those elements of the GPPC paper. So that we don't reinvent to say, "Arey, hum to aise hi karenge because humko aisa lagta hai." You already have a reference point. The second and the most important thing is this is now your new baseline number. And GPPC came up with the next paper, which is called the risk of material restatement arising due to ECL. So therefore, we may want to look at that part of that paper also and therefore address that element of it. So like I said, that there are enough 3 LOD reference, there is enough reference, and by the way, this was deliberated. Do we need an independent model validation? Of course, you need an independent validation because you need to have people like us survive. But keeping jokes apart, you have to do it because validator and the developer has to be separate. You have to have a validation unit, and then they have to do their periodic validation so as to speak about it. And then you have to have pieces around controls associated to it. One interesting thing, and again, this has been a feedback that even we have given while being in the committee, is there are pieces on valuations that needs to be done as well. So if you look at, stage 3 assets, in stage 3, they're saying if it is beyond 5 crore threshold, every 2 years you need to do a valuation. 5 crore is an ASAT, is it a residual value? All of those questions that ought to be answered, but there is that element of valuation. What is the reference on valuation that one would need to look at? Because today I don't have an IFRS 13 from an RBI point of view, nor do we have IVS 500, which is another standard, international valuation standard on financial instruments that needs to be done. So that part of it, especially around collaterals, and then illiquid collateral comes in. Haircuts have been provided, but that is more with respect to the Basel circular and not with respect to the ECL. So we may want to deal with that element of asymmetry. The foundation still happens to be the fact that we need to have foundation of systems, whether it is credit rating system, underwriting system, pricing system, that needs to be there, and that we need to draw. And the good part here is IFRS 9 doesn't warrant as much disclosure. IFRS 7 gives it. We have not referred IFRS 9 and 7. But in the RBI circular, at least the good thing is they have called out disclosure that needs to be given, which is actually a combination of the stage 1, stage 2, stage 3, how you're doing your classification, how you're doing your definition. That, to that extent, it's already coming out. So that's broadly the context around it. I mean, being consultant, I have to live up to my expectation to show a very busy slide. Just to give a context here, we just also wanted to show that if I were to be broadly building out the overall structure, few things we need to be sort of looking out. One is this whole thing around model, and we talked about this whole thing on model on 5 years, at least economic life cycle. But before I go into the model, I need to look at data, and I have to look at data assertions, completeness, accuracies, and we are struggling to see that level of data assertion. And by the way, a very interesting project, again, I'll give a European anecdote. So there's a project on BCBS 239, which at least the global banks would be familiar with, which is on risk data aggregation. That has failed miserably. So now they have come up with a new program called RDRR program, which is now a risk data version 2 that is now being implemented in the Europe that's happening. So clearly that element of data and the assertions and the completeness becomes important. Second would be the pieces around consistency on the sources. And we have seen this being used and abused in different manners. To take an example, today you may be saying that I'm taking EIU data for macroeconomic indicators for my modeling purposes. And for whatever good reason, today, EIU forecast versus an RBI versus a World Bank versus a Oxford data varies, and it could vary. So you can't keep on changing your data source forecasts. You have to be consistent, which needs to be documented. I can't say that, okay, I will only take this one forecast applicable to it. And then the third piece is going to be just on the data around, more around replication and production. And given the timeline, if it is 31st of March 2026, which is the opening balance sheet, if I need to do comparative, I have only as much little time. But even if I had 2027, we will still have as much time because we need to get all of this historically. The second piece is to build the models. And by the way, there was a very interesting question somebody asked. Do I have to build my PD model basis SICR, or do I have to build my PD model otherwise? I said, you will have to build your PD term structure irrespective of your SICR outcome, because you have to have a term structure for each of your products and your segmentation that you've done. So you have to build your lifetime curve, and depending on the tenor of the facility and the residual maturity of the facility or behavioral residual maturity of the facility, do you then apply that element of corresponding PDs and LGDs. A simplification given by RBI is on around LGD, where they've given secured or unsecured 65% and 70%. And then for eligible collateral, they've given 45%. Please bear in mind that is fallback mechanism. We are seeing a very wrong application happen. I'll tell you what I mean by wrong application. Banks are doing the computation. They're finding their actual worked out LGD comes to 85%, which means the recovery is only 15%. And they're saying, okay, but my number is higher than what RBI has given as an easier mitigation. So therefore, I will apply 60% because that's a lower number, and I'll say I have not done the calculation. Please be mindful of the fact RBI maybe can give it as a passing now, but you may not get the benefit on a long-term basis. So those would be the consideration that needs to be done. EIR, and that's something that we got discussed, and we'll talk about some consideration. There is, day one recognition or initial recognition and subsequent measurement coming in. What if you have done a transaction which is off market? What if you have done a transaction which has got a huge moratorium in the underwriting? How do you deal with that? If I go by the basic IFRS requirement, then you will have a day one recognition also. By the way, there is a serious deliberation that's also happening across many to say that is there a grandfathering possibly one could give. What I mean by grandfathering, to say, okay, आपने तो fees and cost and directly attributable expenses आपने नहीं किया, या premium discount आपने identify नहीं किया. And therefore, to that extent, I will not have the ability. I can take assumptions, but assumption as good as crystal ball gazing. So I will therefore not do as much of assumption, and I will give a grandfathering. That is a deliberation that is coming in. Whether that is going to be effective, I don't know. But if it is not, you'll have to go back to finding out how do you capture the fees, cost, premium discount associated to that thing. And then that becomes your YTM. So then you'll have a drift between your contractual yield and the YTM, or the EIR as they may call it, and get the answers. So broadly speaking, from an overall perspective, governance, one would need to look at with respect to the ECL governance setup, which is going to be board approved. And we have sort of done some prioritization basis our experience. Policies, control framework, internal design and methodology, and post-model adjustments to deal with. Then we have this whole thing around model risk management, where we have to bring in this element of model inventory, model tiering, model validation, periodic versus revalidation, whether I do a model level validation, do I do a parameter level validation, how do I go about it, and defining the thresholds around it. And then this whole thing around internal audit. So clearly there is this whole thing around third line that is coming in to say, what is the compensating control? What is the data lineage? What is the critical data elements associated to it? So clearly those are pieces. And then with respect to the systems, clear question around NPA system, getting the flags done correctly, because now if I'm going to have new definitions, we should have the ability to have those flags plugged in early on to do it. Collateral, because we have collateral, what is the level of haircut? How do I look at collections of that? That remains to be there. Internal rating system, especially for wholesale loans. So do we have a master rating scale? How does that get calibrated and built on? EWS and reporting. What I also thought is maybe, since we have CFOs in the room, deal with a fewer nuances that needs to be dealt with. This is going to be a change in accounting policy. So how does that get reported under AS5? Because there is still going to be this accounting piece and the financial reporting pieces that needs to be addressed. So how do I deal with this AS5 reporting? Second is with respect to recognition of financial asset. So therefore, we could also have a situation that the disbursed value may not be the value that is recognized as loan value, depending on the premium discount and or off-market transaction associated. So recognition of financial asset, that is going to be there. EIR, like we discussed, is going to be a very important criteria. One is historical ability to do it, but more important are future ability. So banks, and we know for a fact there have been banks who have been affronting fee income, which is actually nothing but the YTM. Those will get seriously impacted, at least if the grandfather is given good. Otherwise, they will get impacted even on the computation to begin with. When it comes to provisioning, clearly there is a standard in auditing called ISA 540, again for CFOs. Your auditor will refer to this ISA 540 as a reference, which is international standard for auditing, 540, which talks about how you audit ECL. That needs to be done. Comparative financial statement, like I mentioned, is going to be one important criteria of how do you do a comparison and how do you deal with it. And we still don't have an answer. But if the right version were to apply, then April 2026 is where the kickoff will start coming in. So you need to be mindful of. Consolidation, I talked about, if the holdco is a bank and the subsidiary, and we have got quite a few in the room who's got a similar structure. Then in that case, how do I bring in the asymmetry? Do we therefore want the NBFC to start aligning the methodology to the bank? And that is going to be an Herculean task because they're already in a moving train, which is now caught fire. So we just need to be mindful of it. And then the additional disclosure that comes in. What I also thought, and maybe I'll just keep this, as a practitioner, I see a lot of momentum and hoo-ha about the fact that ECL aa raha hai. But साथ में SSCR भी आ रहा है. अभी SSCR आ रहा है, only standardized approach in credit rate. SSCCR नहीं आया, counterparty creditors नहीं आया. तो SSCR जो आ रहा है, वो भी April 2027 में आ रहा है. There are going to be a fair amount of deviation. Now, let me start with the basic. If I were to look at the standardized approach creditor circular, they've actually given what level of CREs needs to be captured, what level of rated versus unrated in banks has to be done, what happens for retail. So clearly that level is there. And if I look at project finance, and let me take that as an example and put that as a reference to data. For ECL circular, it says for project finance, there is a stage 1 loss and a stage 2 loss. But then for project finance, they're broken to say it will be for operation and construction period. There are again breakages in that. That is itself a problem because abhi project finance mein you have to start capturing the data. But when it comes to this new standardized approach, they go one step ahead. मतलब खिलाड़ी का बाप निकला. उसमें क्या है? You have to now look at high quality projects and low quality projects. So you have actually 4 variants of the same thing that needs to be captured. So what my suggestion is, as you build in your data taxonomy, please be mindful of the fact that you don't do this data taxonomy in isolation. You have to do this data taxonomy in conjunction with what is following. Also be mindful of the fact that for your standardized approach circular or under credit risk, segmentation is defined, which could very well be and will very well be a departure from your segmentation for ECL. You need to be mindful how the 2 is being captured. So that's going to be one piece. Similarly, there are pieces around sovereign. So agar aap Basel ka definition dekhoge under sovereign, it says that you have to apply, effectively says that for central schemes, you apply a 0 risk weightage, provided the money is claimed in 60 days and collected in 30 days. How many of us are dealing with CGT MSC today? If you look at the real collection, it happens in a year. Now you've got a 90-day threshold that is there. How does the 2 align? We'll have to sort of get to that. Now, if this is going to be the case for the Basel circular, how do we align with the ECL circular? Again, those remains to be a consideration. Likewise, for credit rating and CREs, there is this credit rating agencies, there is whole element of due diligence that one need to be done, and then you need to do notching up and down. How does that have an implication with your SICR trigger, saying that, okay, my internal has changed or my credit rating has changed, and while it did not warrant me to do it, how does that interplay come about? Haircuts, whether with respect to LGD computation or others, there are haircut threshold that has been called out. Here you have to compute your, so the reason I just wanted to bring this out is not to talk too much on the SSCR circular, but to talk about the interplays that is coming about. Because I'll give you one very interesting nuance that is coming in. If I read the SSCR circular, it says, treat NPA exposures as specific provisions. That's one part of the circular. And here comes the ECL circular, says, stage 1 will be considered for general provision purposes. Stage 2 and stage 3 is going to be specific provision. Again, a bit of a, how do you deal with the 2 circulars coming in? Because 2 circulars, one for capital and the other one has implicit implications on the capital, so as to speak about it. CCF, and we are seeing a transition given from 5 to 10% on the CCF, whereas here we have to do this computation that needs to be done. So my one thing that I would want to leave everybody in this room is, while we are overly enthusiastic about ECL, it is very important and I don't take that away, but please be aligned with the overall framework and the data, technology, and the system needs with respect to the computation. So, good, thank you so much. So, just to conclude, I mean, as a practitioner, I think there are 8 dimensions we need to be slightly more ingrained. Data remains to be key, and I think in any conversation that you go, it is going to continue to be the case. 5-year data remains to be there. You may not have a 5-year history. Doesn't mean that you have to start synthetically create. No. One thing that RBI has very clearly called out is they will not allow cherry picking, because what we have seen is during the period of COVID, NBFC said, "अरे ये data तो मेरे लिए relevant नहीं है. अभी तो moratorium दिया है, या तो deferment दिया है, TLTR हुआ है. So therefore, it is not applicable to me." The word RBI said that we would not allow you to cherry pick data. So please be mindful of that. How do you build that? Whether you do by weightages in the data cohorts or do whatever it is, how do you deal with that and the granularity? The second piece that I would urge us to look at is in terms of the modeling and the modeling techniques. While I would have liked that to be published as a part of the RBI report, it has not been published as we speak. Like I said, there is no one size fits all. There are different models that will be applicable to different types of portfolio. Macro variable selection, please don't fall back on the, ease. It's like, there is also a clause in the standard which says undue cost and benefit, you don't have to compute ECL. So like that, we don't take this ease on the fact that, I am not able to prove a relationship, therefore there's no macro applicable to the relationship, because you'll get caught in the conversation, because when you go to your ICAP documentation, you would have said that here is my 5-year projection, here is my capital planning, here is my stress testing, here are the parameters impacting my portfolio. Then suddenly you'll have a contradiction between that. Likewise, what I would strongly recommend, and by the way, those are thematics that is coming out for NBFCs today, is how do I make sure that my alignment of what I reported for A report is similar to B report? To take an example, today we are doing a reporting for ALM purposes, and I have a scheduling of the cash flows there. How do I make sure that that cash flows are having semblance to the EAD cash flows that I'm doing? We need to be mindful. Sometimes we oversimplify also, and we have seen that. I have cash flows. I don't know what the underlying term sheet says. I use a PMT function to do my amortization of the cash flows, which maybe at aggregate level has a lot of semblance, but at a loan level or a facility, and this is by the way a facility by facility assessment, that has got very little semblance around it. If we end up applying a PMT functions to do cash flow projections, then to that extent, staging will have a catastrophic impact on the computation. So please be mindful of that. SICR, like I said, please get your definitions right. Be consistent. Can you change it? Yes, you can change it. But be mindful of the fact that you don't do minimum compliance by 30 days. And that was the whole objective of coming with the illustrative guidelines, both for NPA/default and for SICR. EIR recognition remains to be important. Floor will be there. One can possibly argue 5% is not good enough. It should be 3%. Representation is already gone. And like Sir mentioned here, IBA will continue to take representation till the final circular comes. Please make your representation, give your data so that collectively that can sort of go back to RBI to say, okay, this is why we believe, as against saying why we want a number. And post-model adjustment, you will not like the answer. If you're doing an adjustment and overlay, which will happen in reality, please document. So I think with that, I'll take a pause and maybe open up to questions if I am able to answer.
Yeah, Mr. Banerjee, very good presentation, I think very comprehensive presentation you have given. Because you are into this ECL from the beginning and KPMG per se, 1 or 2 points I thought, let me ask you. See, whether you have made any industry level kind of assessment, like see 2 circulars come, one is ECL, another is credit risk related circular where Basel III credit risk guidelines will be issued, will be implemented from April 2027. So one side here the positive, negative impact is there on the balance sheet. That is what is the broader expectation. And other side, there may be a release in respect of that credit risk related guidelines. So any industry level assessment has been made that to what extent it may offset or it may not offset or both will be having negative this thing. Any industry level this thing has been made.
So some deliberation which I can publicly disclose, some which I will not be able to disclose.
So and one or 2 more points. Good point you have told that in the beginning that the RBI has to mindset-wise, RBI has to come out of the rule-based regulation to principle, because we also, argue with our SSM to justify that we are going for principle-based. So don't question. So this, your understanding SICR is very good. Agriculture portfolio is a big portfolio for public sector banks. That the DPT-related issue, which will be having an impact on SICR, that part I think needs to be taken more intensely, so that some benefits can come, or clarity may come to us. And model risk also. Model risk circular, I think final guidelines should come. Otherwise, alignment will not take place. When model risk comes into, new final guidelines is issued, if something else is there, then the entire my process will get hampered.
Sure.
Thank you.
And maybe if I'm not able to answer, like I said, that I got more able people, Shushanta and Vasu sitting, so we should also ask them. But few deliberations that happened, like I mentioned, we had almost 20 meetings that happened, which also included outreaches that was done to the industry. Separate segments, systemically important, systemically not important, or maybe smaller, across institutions who are already filing. So there is that outreach that happened. So that had an element of anecdotal references on data computation challenges. So that's one. Second, and by the way, a very interesting discussion that we had was with respect to, are pro forma to ja raha hai. All of us are reporting in this room on pro forma. So agar pro forma reporting kar rahe, so that should be the ECL. You should have the number. Then suddenly we had that eureka moment to say, yes, pro forma was being done, but way too much of simplifications and assumptions. PD के लिए भी assumption, LGD के लिए भी assumption, CAD के लिए, तो फिर बचा क्या है? तो तीन को multiply ही करना बचा है. But anyway, that is how it went. So there was way too much of assumptions that was being done for the pro forma reporting. I am aware of the fact that even outside the committee discussions also, RBI did reach out to some of the large institutions to give data to make sure that there is some semblance to it. One thing which I'll not be able to answer at this point in time, and I don't think I should answer also, is the basis of determination of the thresholds of stage 1 loss, stage 2 loss, or stage 3 loss, because that's something the regulator has done, keeping all data that they have been doing as a part of their regulatory process. So that's in terms of, so there is some thinking around it. Will we get this circular right to begin with on day one, or the application of the circular? The reason I gave the whole ECB supervisory priority reference, which came about a week back, is essentially to say that 7 years have passed since Europe has moved to IFRS. Yet we are finding the supervisor talking about stage 1, stage 2 issues even today. So I don't think that whole element of overnight gearing will happen. So that's one thing that I want to call out. Second is, I think if you really understand the mood in the room, there is no mood to give back provision in the P&L. And therefore you have that element of, so even if you are good, that floor. And while we may want to say, and one very interesting discussion that happened is, Abhi, you're talking about ROC, REROC, and risk-based pricing, right? That's what you want to link it back to. But that is commensurate to, if I had my numbers basis ECL computation. Now, if ECL number happens to be 2% and your floor happens to be 5%, usme main kya REROC lagaun? Valid point. Maybe those will unfold over a period of time. Will I have an answer to say ki when will that go, or how will that go, or what will be the reduction? No. But clearly, but at least the appreciation is underwriting is not going to be decoupled with how businesses looked versus how risk is going to look and finance is going to be looked. And therefore, that whole embedding seems to be a conversation that it is, I believe, is going to drive the discussion forward.
Yeah. Can I ask?
Yeah, sure.
Sir, actually, in your presentation, it was an excellent presentation. You have taken 2-3 points, like the effective interest rate computations, and then you told about the disclosure has to be on a YOY basis. So, since you have also highlighted that these are the challenges as of now, this effective interest computation, whether any representation has been given for some sort of a relaxation or dispensation, because effective interest recognition jo hamara hai, it should be prospective or from the retrospective, because then we have to dig in the our earlier data also. Whether some presentation has been given for some dispensation, that it should not be made retrospective or prospective, something like that. And third point, you have touched about the general provisioning. Stage 1 is going to, stage 0 is going to be the general provisioning. And for carry forward of that general provisioning, presently there is a ceiling. how much you can take 1.25%, whether there is some debt cap will remain or some presentation has gone to the RBI for relaxation.
So as far as the presentation, I'll reflect it to you. But what I can also say is, while being in the committee, we have also given a representation to say that some things. I'll give an example, and maybe I'll come back to your point, but I'll give an example of a representation where we have given. There is a concept of POSI asset, if you're familiar. POSI is purchased and originated credit impaired asset. And the whole premise of POSI asset is you have got a stressed asset, an asset valued 100 is asset valued 40 today because you've got inherent credit risk associated to it. Globally, they're outside the measurement of this whole general measurement approach, which is stage 1, stage 2, stage 3. And POSI globally is measured at lifetime loss. Because you're saying it is a stressed asset, the underlying cash flows will effectively determine what is the effective loss. And therefore, you always do a lifetime loss, right? Because you're saying, I will look at what is the time to recovery, cost to recovery. Interestingly, in this circular, POSI asset has been put as stage 1, which now come to think about it. You are bank A and I'm bank B, okay? You've got a POSI asset, which is carrying a lifetime loss, 11% loss, hypothetically speaking. You say, okay, Rajesh, why don't I give that asset to you? You take it from my book. You will not book a lifetime loss. Let's assume the residual maturity is 7 years. You will not book a lifetime loss because it becomes a stage 1. And what is the inherent definition of stage 1? It becomes a 12-month loss. So when I book a 12-month loss, will my loss be more than yours? The answer is no. Possibly I will end up booking a 8% loss as against 11%. Am I creating an asymmetry and a systemic risk in the market where you start seeing asset swaps? And then suddenly you'll find everybody selling the assets, bad assets, it becomes good asset in your book and vice versa. And that is a departure from the accounting side. So there is representation we have given despite being in the committee. So that's number 1. Second, let me come to a point on EIR that you asked specifically. If you go back to the genesis of IFRS standard setting, and maybe Narayanan is here from HSBC, and I consider him somebody who is on top of his account, not that others I don't. There is this requirement of saying I will have to go back when I apply an accounting standard retrospectively for anything that is outstanding on my book, which means now there are application processes. I can do a full retrospect, I can do a part retrospect, or I can do a fair value as an application. So if you, in your case, if I am unable to determine what is my fees, cost, premium, discount associated to it, then I will either do from the time I can capture, so I can do a part retrospect, or I do a fair valuation. Those are applications that is there. Unfortunately, like I said, ये थोड़ा खिचड़ी standard बना है. You don't have a first-time adoption because it is not an IFRS standard to begin with. Then you got bits and pieces coming in here, and then you're dealing with it. So EIR, if it was to be done in the true spirit, then you had to go back and get those elements that had to be done. In this case, because it has come in, the good thing is it has come in. Let me put it this way, sir, because if I get this, because if I don't define what my discounting rate is it cost of fund? Is it MCLR? Is it what is it that is going to be a FTP? What is the discounting that I'll apply? That remains to be there. So in my view, in the current shape and form, if nothing but to be clarified, I'll have to go back and get that adjustment done unless there is a dispensation. As far as representation is concerned, I'm privy to the fact that there is a fair amount of representation which IBA has done to RBI. And maybe I'll leave it to your good officers to respond to that, sir, if I may.
Mr. Banerjee, this is Bhaskar from Credit Agricole. Question on the derivative side. So unless I'm mistaken, there is a provisioning requirement on the derivative as well. So I think this is not in line with the global standards. Any thought about that, why RBI wants this to be done?
So I can only tell you the response that we have given to RBI. So that derivatives basic definition is FETPL, unless you apply hedge accounting. And any financial asset which is measured at FETPL technically does not apply an ECL. And I rest my case here, if that gives you an answer.
Good afternoon, sir. Thank you for the insights. My question is, what according to you is the biggest operational bottleneck in implementing ECL in the initial years?
The biggest bottleneck in my view is mindset. We are still in denial that we don't want to do ECL and we can get away making representation. There is no other bottleneck in my view.
So do you think
so long we are all embracing to the fact that it is here and now, we can decide the variant on which we may want to apply. That could be a different question. First, we'll have to go away from the mindset that this is here and now. And the very fact that the discussion paper, after so many deliberations, has finally come out, is going to be the first start. The second bottleneck in reality is going to be this whole element of data. I mean, you can go to any meeting and say data is the biggest problem, which is true. Whether you go for a AI session and say, "Arey, data nahi tha, to main LLM model laga nahi paya." But data, in my view, is this whole thing around how do I get my migrations? And more important is, even if you had data, how you define your definitions on default and SICR will become important, because you have to go back, roll back on the data to have that. Now, those flags were never enabled in your core banking system and any other CRM systems or LOS and LMSs to be there. So you just need to make sure that those pieces on the data is going to be applicable to it. Third is also, there were a lot of KPIs that were put around collection, analytics and stuff like that. But with respect to recoveries, with respect to write-offs, write-off was never defined in as much black, or maybe you would have seen that definition move over a period of time. Because we have not done that, we have not captured those elements of data, or done that attribution saying, कि यार ये तो 2020 का loan था, 100 रुपया का. This is the write-off associated with that. So I think those pieces will end up being this attribution. Modeling is definitely a concern, but I would not put modeling as the first. Modeling will follow once everything else is going to be there. I think one interplay that becomes important is to make sure that we have a fair amount of alignment between risk and finance, how we get going on this one. We have a technology embedding around all of this coming in, because anywhere, if it is misaligned and overlaid, then it becomes a bit of a challenge. So I would just go back to the 7-8 buckets that I mentioned is where you need to be focusing on. Everybody will have a different, for foreign banks, I can tell you for a fact, foreign banks are now having this conversation that I have to redo my model. So then the question is, if I'm to redo my model, how do I do it? Because in some cases I've either not captured or I have no basis. How do I do a oversimplification around it? On the model, I deflect the question to Narayanan. He will give you a good answer of what the largest bank can.
Thank you, sir. When you say about the mindset, would there be a cultural shift?
I mean, it is here and now. So I think you better shift is my answer.
Thank you, sir.
Yeah, good afternoon, sir. My question is regarding this gold portfolio. Very high provision is proposed for I think 1.5 is rather than.
By the way, I can tell you there is a lot of representation that has gone on that one.
Because it is very secured, even it is as good as OD against deposit, loan against fixed deposit, where low provisioning is there. So that portfolio also we can think upon maybe 0.4 or something.
So I can tell you that you have many like-minded people in this room also, who has made some representations to say that कि इसमें तो कुछ करना चाहिए.
Take it.
Thank
Okay,
you.
on that note, thank you so much.
Thank you for the detailed and informative presentation, sir. For the audience, let me also share that Mr. Banerjee is the partner and deputy head, risk advisory and head financial risk management at KPMG, bringing the rich expertise to this session. Thank you very much, sir. May I invite Shri A.K. Goel, Chief Executive IBA, to kindly present a memento to sir as a token of our gratitude. Thank you very much, sirs. Ladies and gentlemen, we now take a short tea break of 5 minutes only, please, so that we can continue with the engaging discussions after the tea break. Please come back quickly. We now move on to our next session for the day. This presentation will be delivered by Deloitte and will focus on a very important theme: model risk management, a strategic imperative for resilient organizations. May I invite Ms. Aruna Pannala, Partner, Risk Advisory, Deloitte team, to begin her presentation, please.
Noon it is. It's absolute privilege and an honor to stand in front of you and talk about a subject that you already deal with it day in, day out. And for some, it might sound, and I use my words carefully, it might sound esoteric, but since you already have been managing this, my task here is actually to ask you some questions and for you to gauge for yourself if what you're doing is adequate, what you're doing is something that is going to make your organization, as it says, as the title of the session says, a resilient organization. I'm cognizant of the fact that in this group are CROs and CFOs. So this is not a session where we're going to be discussing statistics, statistical outcomes, what are the validation techniques, and what are the thresholds that we will need to be able to accept or reject a model. That's for a later date. What we have here is possibly something that mostly are rhetorical questions. What is a model? Do models really fail? What is it that makes us anti-fragile, resilient, possibly have a control environment? But to know that, what do model risk failures really tantamount to? Those are some of the questions that I'm going to be covering here. But happy to have a conversation on this, because there's clearly not much to say without the contribution and active engagement with you. If my voice is a little quivering, don't mistake it. I do have cold, but also it's making me nervous with all of you in front of me. The first and the foremost is we dabble with the question, what is a model? A lot of you in your policies and whatever we've seen, and what the regulators have looked at it as a set of computational methods, financial, statistic, economic, but nevertheless computation methods that are going to give you, based on some input, an output. That is as broad a definition as models can be. But if you look at a model, if it's a micro representation of the world that there is outside, then we are looking constantly at how good a representation it is. Because underlying that are a set of assumptions that we make. Underlying that are a certain set of data that we use to be able to indicate as a representative sample of the world outside. And those choices bring in a certain element of risk. I'm sure you all agree with that. And consequently, the first aspect of anything to do with model risk management is the definition of models itself. And what we've seen as an industry practice is we've seen LCR as a model. We've seen capital calculation as a model. And I'm not, by no means am I referring to IMM or IRB. I'm talking about standardized approach to capital calculations. We've also seen EWS framework as a model. And of course, we've seen PDLGD, EAD, which are very relevant from the session from the earlier speaker, very relevant. And of course, stress testing models. We've seen a whole host of these things called as models. Would you think that a framework can pass off as a model? I know I've been told that I have about 30, 40 minutes, but I would like to keep this conversational rather than keep questions at the very end. So happy to have a conversation or dialogue on this. We have had the opportunity to inventorize a bunch of models for some banks, and the often question that comes up is a framework a model? Is capital calculation methodology a model? Would you agree capital calculation as a methodology is a model?
Predictability is one of the criteria. It should be ambiguous and it should not be biased. These are the conditions RBI has given. So capital calculation is like a simply I am giving the input, which is again coming as an output from different models, and state calculations is coming. But the point on deciding whether any kind of output is a model, there RBI has clarified even a scorecard model is also a model. When I'm making a simple scorecard, that also is a model because it is unpredictable.
So scorecards absolutely are models.
And there are assumptions. The reason behind is that there are assumptions. Whenever there is an assumptions behind any parameters which are put in the scorecard, then that particular activity is treated as a model.
No dispute there, sir. There is, in the capital calculation equation, there is an assumption. In the capital calculation equation, there is a set of rules, possibly modeled outcomes that are there. The question really is that a model risk for the banks, or is it a model risk that RBI has for having developed that model and given you the output of to apply on the risk for the risk weights on your capital requirement purposes. So the question is, let's now look at EWS. There's no debate about scorecards. Scorecards, whether it's judgmental, quantitative, they are models, and because there are assumptions about what factors you are taking into consideration, how you're profiling them, all of that, absolutely scorecards are a model. So there are, if it's qualitative, of course, there are many other techniques to kind of backtest it. Coming to EWS framework. Is EWS framework a model? I'm choosing my words carefully. It's a trick question. Is the EWS framework a model? There is a rule engine, but in addition to the rule engine, there's also how you're going to close, how you're going to do the red flagging, and once you close, what is the kind of feedback loop, etc., that you might have. So rule engines, computational methods, anything that you use for signaling and profiling generally are considered models. The reason I'm spending this time here is otherwise, what we will put in as a throughput into our model risk management framework can become enormous. Global banks typically have about 1,000 to 2,000 models. What we've seen in India is about 200 odd models as an inventory for us to be able to run through the model risk lifecycle management. 200 models. Now, some of you in the risk function, would you wonder, do you have 200 models? Do you use 200 models? If you look at all of credit, maybe about 15 models. If you look at all of stress testing and ICAP, another handful of models. Interest rate risk, because of the behavioralization of the balance sheet and behavioralization of the calculations, maybe a few more. Capital models, well, you're using standardized approach. So where are these 200 coming really from? Yeah, that's all credit, PD, LGD, all of them put together. Sorry, the valuation models. So largely you look at your global markets, FIMDA-driven, sometimes rule-based, unless they're complex products that you have. All of them put together. I'll give a range. Maybe if you can give us a guesstimate, right? 50 models. 50 models is a reasonable range. 100 models. Do you have 100 models? Anybody with 100 models in the credit risk function? In the risk function, sorry, did I say credit? My bad. It's in the risk function, 100 models?
100 models will be there. Other than that, stress testing models are there.
Yes.
We have got state government rating models. Okay. And there are industry assessment models. So all are related to credit ultimately.
With you. 150 models? 200 models? All of these are risk models, or what is also happening, and this is another trend that we've observed, is that given the definition of the model, we are also looking at not just models that are used by second line of defense. It is not just what the risk management function is looking at as models, because we are trying to bring in a whole host of governance which is not limited to risk function, it is for the entire enterprise. We are now looking to sweep in a whole host of first-line models as well. And there you will find that the numbers actually balloon. Balloon because you are looking at marketing models, you're looking at cross-sell models, you're looking at how application scorecards, and you can have any number of segmentations that you might want to have, and therefore you'll expect that the number of this will actually balloon. Balloon will give us a reason to exist as model validators, as model risk management teams. But unless the outcomes that we are going to be looking at from model risk management perspective are tested, are well governed, you will not be able to prove the value in a day and age where everybody and everything is being questioned for ROI. we can say that we have a number of models going into hundreds, but all of those hundreds of models, unless you have a mechanism to say, by doing a robust model risk management by having a model risk management framework, a robust one at that, you're not going to be able to protect the organization. Unless you establish that, you will not be able to get far ahead. Because the question is today, a model can be validated in 3 days flat. The speaker in the previous session also spoke about data, data, data. Yes, no session on anything to do with a bit of estimation goes without talking about data. But if the data is in order, 3 days is all model validation takes for one model. So what is this fuss about model risk management, therefore? It has actually been reduced to a commodity, and as consultants, we can tell you that. Model validation is reduced to a commodity because there's some techniques that you use, you get some outputs, the report is generated, and you can discuss it with the model development team, model validation team, and be done with it. And we've done this. But suddenly this comes to the fore, largely because of the impact these models are now going to create in not just in the way that you are able to see and tell, but also in how you are going to be looking at provisions. Your external world is going to start looking at the outcomes of those models and then question the veracity, the dependability, the traceability, the appropriateness of these models. And therefore, when we talk about a resilient organization, we thought we might want to look at the whole host of things, largely, not make it a mechanical exercise of validation techniques, but look at it of what can really break if the models don't work. In preparation to this session, in the run-up to this session, the question that we asked ourselves, as I mentioned, is, do models really fail? And when they fail, what will be the impact? Do models fail? Not a statistical answer. Do models fail the bank? Do models make a bank more risky? Yes, they do. How? How? What if I use an interest rate risk model to determine what is my NII and EVE, and that model goes wrong? What happens? Sure.
Different kind of impact on the entire bank.
If a model goes wrong, because we're going to be
because
using both that
decisioning
information
is entirely dependent on the model only. Say suppose even if there is a x plus y equal to z, and I'm not looking at x plus y on a daily basis, I'm daily looking at z, and if x, which is coming from some kind of computation, that goes wrong, so since my entire decisioning is based on that z, so then certainly there's a big risk. Because
so using the models, so using the models where you're going to be using the output of the model for decision, possibly that can have a bigger impact. Any other place where models can cause failure to the proportion of a bank failure. Any instance that strikes to you? Or is it the case where model failure is not a once in a lifetime event, but it kind of grosses up over a period of time? You just fail to ask the right questions. You just fail to challenge the assumptions under which these models are working fine, and that is what leads to bigger, massive failures. The point I'm trying to make here is
underwriting, even
sure.
The model dependence, your underwriting, there is a slight kind of mistake over a period of time, your NPA can go to any extent.
That's the point I was trying to make, sir, that when you use underwriting models, possibly you're not catching the real risk of default, and so you will see that over a period of time, the PD possibly goes up. But that is an accumulation over a period of time. When you do stress testing models and you find that you have not sufficiently stressed or tested the assumptions that you've made, only when that event occurs are you able to see whether that your model has failed completely. But otherwise, at a point in time, to say that model failure has resulted in a bank failure is a far stretch. Why? The reason you do model risk management is to ensure that the small delta of model errors do not accumulate over a period of time for you to be able to set aside either capital or possibly many other repercussions of that, right?
Model review has not taken place. See, model review we have to validate the model. If model is throwing wrong output, then the validation review also needs to be placed. If that process fails, then repetitive mistake will take place, and that may lead to the organization failure.
Which is why I said this is not a session where I have to say anything new. This is absolutely right. So a model failure is not because the model algorithm is wrong, but possibly, right, questions have not been asked when the model was being deployed, developed, or possibly been implemented. Possibly the assumptions that were made were never understood in the run-up to the model development and deployment. Possibly when questions were asked, they were not sufficiently satisfactorily answered, right? When assumptions were made, the assumption testing did not give you the results, or you did not wait for the results before you went ahead and implemented them. And it's also likely that the model that is being developed for a certain purpose, because you want to launch another product, you went ahead and tweaked some parameters and said, let's use this as a proxy until we start looking at the data that can tell you a very precise model. All of these are actually not an algorithmic failure. And as you pointed out, which is what is the deal about model risk management, is the algorithm is the heart of it, but everything else that surrounds it is what is making the organization resilient or not, right? That is why we see that, sorry, any comment here? So that's why we're saying that, from data all the way up to model, I'll come to monitoring. Whether it's in the stage of development, validation, deployment, in all of these areas, you will find that unless they're sufficiently challenged, you will find issues cropping up. On the instance of model monitoring, I think depending on the type of model that you have, whether you look at a 12-month validation, but of late nobody's talking about a 12-month validation. We're talking about very regular, periodic model monitoring. And if the model is a ML model, you're also looking at continuous monitoring to see if the model is giving you errors. I will not go as far as saying errors, but at least values that are not expected. And therefore, this model monitoring gains a lot of traction right now to see that while you can do full validation periodically, most often than not, you might have to monitor the model outcomes more frequently, and in some cases on a continuous basis. The choice of when you need to do this, for what type of models you want to have a certain rigor around monitoring, we'll talk about that as well. It's a part of the tiering approach. Regulators are concerned about model risk management, and there's no telling because, of course, the PD, LGD, EAD, I'll keep connecting this back to the circular. But it's not like we have not always dealt with models. The underwriting models have been there forever, Amen, and you've been doing validations for 15 years at least. As I mentioned, the reason...
But as you said, 1 year, 12 months, no. We are also concerned about the RBI guidelines, where it is said yearly validation. See, if I am doing a rating model which will assess my credit risk embedded in these proposals, I think 1 year is too short a period. If I develop a model, if I validate it and then put into deployment, then 1 year is not enough. I need to have at least 1 or 2 years time to know whether model is showing the correct thing or not. That maturity time has to be given. Otherwise, it's too premature. See, quarterly I cannot validate a model. So that 12 months time for all models may not be appropriate. That is our view.
And the catchphrase for me there is all. That's why I said you have to tier the models to see what goes through what level of frequency and what level of rigor in trying to do the validation and monitoring. A whole host of risks that emerge as a consequence of model risk management, and this is too academic a slide to say that what triggers and what manifests as model risk, but the point of this slide is actually the heart of it. There can be many reasons why there can be a failure, but it will all be attributed to model risk management, model risk failure, and can you afford to have that? The reason, it could result in a reputation, it could result in a lot, actually sometimes litigation as well, But the question is, this gains importance from the point of view of the moment a modeled outcome is going to be used for public disclosure, it is going to be up for a lot of scrutiny. That's the real point of this. The first time any reference to model risk has come out is actually in 2011 circular of RBI, the draft regulations for IRB. And subsequently, in bits and pieces, they've spoken about how you should have a robust model validation framework when you're talking about IRRBB. ECL paper discusses it. There is a draft paper on model risk management, but also now the ECL talks about it. But any guesses as to why, and we try to hazard a guess as to why, like SR 11.7, like TRIMS, RBI has not come up with a model risk management paper. MAS has it, HKMA has it. Why wouldn't RBI come up with something which is a straightforward model risk management? Because the model risk draft also talks only about credit models, credit decisioning models. But
probably that IRB circular has gone to a back burner. Probably that is the reason. Otherwise, it is integrated with this IRB circular. So when AMA was, deferred, so that time I think the relevance has gone.
God bless AMA, but I think that's where I'm sure the representation has gone from IBA as well on this, which is to say that the definition of models, what all comes into model risk management under the circular, there was this question around if bits and pieces of it was set out in the IRRBB circulars or the ECL circulars, the model risk management framework should actually talk about all of model risk in a holistic manner. The idea possibly was to say, let us first focus on credit risk models, but it defeats the kind of logic of when you are trying to build a model inventory, which is the first step towards any kind of model governance. This kind of is, maybe we are going to, once the draft circular becomes the final, we're hoping that the scope of this model risk management changes as well. But largely, if you look at what is the focus of the regulator in trying to build any model risk guardrails, is really that strengthen the governance around this, which is, I think, the whole point of this session as well. Strengthen the governance around it. Look at the data or infrastructure that is going to be the critical input, and basis which whatever outputs come and whichever way you use it. If you're going to use models, see the output and then decide. There is a certain kind of risk, that is a delayed risk possibly, but the velocity of risk further increases when you're looking at modeled decision making, which is quite apparent, which is quite possible when you're looking at straight through processing for small ticket loan items. Almost all of us are focused on getting a better ROI, I mentioned that. Almost all of us are focused on reducing the cost of operations. In that bit to do that, and any first-line business leader is going to tell you that the more straight-through I have, the better it is, because the cost of operations goes down significantly. My service TAT for my customers goes up drastically. Therefore, the insistence on going towards a straight-through. But what that will bring in is a modeled model risk, where the velocity of risk is going to increase before you really realize, unless the model monitoring is very frequent or maybe even continuous, before you realize that something is going wrong. We'll talk about culture later. It's very fancy to talk about this and also quite difficult to change. We'll talk about that later. I want to spend a moment on saying that as you build your inventory of models, you might want to look at it in a stage-wise approach, simply because by putting your arm around hundreds of models, I bet that you do not have a large army of model validators and model monitors to be able to take care of whether each of these models is working fine or not. They're smaller teams. All that's going to happen, and we've seen that happen in a couple of banks, is the moment you have 200, 300 models inventorized, you will have to put them through model monitoring tests, model validation tests, etc. And that in itself, because of the lack of capacity, is going to be a hindrance. So our suggestion is to think of it as a stage-wise approach, where you're going to be looking at the most critical models. By that I mean critical models that are going to be looked at it from a regulatory purpose, critical models from a risk management standpoint, models that are going to be using for accounting provisions, etc., take those as the first few, and then when you're looking at marketing models and the others, the first line models, you might want to take them subsequently. Because you need to flex the muscle of model monitoring and model validation as well. To be able to challenge, to be able to ask the right questions, and you also want to spend, I'd say it's a risk-based approach, you would want to spend your finite resources on the most things that matter the most. But the focused approach really is about what kind of inventory and how do you take it stage-wise is really the point here. Governance and accountability, I think we do have, almost all banks today have governance committees. No model goes through without any kind of an approval process. The question really you might want to ask yourselves is, the people sitting on the committee, how much do they really appreciate not just the statistics of it, understand and question and challenge? Some of you might, or maybe all of you are sitting on those committees. Are you challenging the assumptions enough? Are the assumptions and limitations of the model sufficiently discussed or glossed over? Do we, as model developers, model validators, understand the patterns and assumptions that we are making even without understanding them? So the question is really about asking the right questions. That is what is going to make this effective. Otherwise, from a structure standpoint, the number of committees that you might have, the number of specialists that you might have, quote unquote, in these committees is possibly sufficient, if not more. Coming back to institutional readiness and possibly culture. Does model risk management really have to do anything with the culture, or is it just that these days, if you don't talk about culture, appetite, and data, you don't, culture, appetite, and AI, it's not a session that's complete. Is culture really important in model risk management? Clearly not. Silence is golden. Is culture important? Can I say, well, I don't know. This is what the this is what the model told me. This model has been implemented on my SAS or OFSA or my Murex systems, and it's given me the output. As I do every day, I just used it, and I did not know it was wrong. What is happening in this example? Which is fair. I work day in, day out on the outputs, someone said, outputs of the model. I rely on them. So there's a culture issue here. Some of the foreign banks, the model ownership actually lies somewhere else. I'm a mere user of those models. What change, what latitude do I have to change? So is model risk really about a culture issue? Any thoughts? Is it about ownership? Or the model user is just left to fend? Because when something goes wrong, somebody will have to clean up, and that somebody who's going to clean up is really the person who's using it in their day-to-day business, may or may not know the algorithm that goes in. Either that algorithm is within the control of the bank, or in the channel partner, or in the global office. So who owns it? I think one of the critical points from an RBI standpoint also is ownership, therefore responsibility, accountability to ensure that the model works. Users, the culture shift is really to say, while I'm using it, the idea is not to say, I'm simply the user. Can I ask the right questions? Can I see if in all circumstances is this model working fine or not? It's not to create a paralysis in the organization where everybody starts asking every question. But without thinking about what these outputs mean, how they can have an impact on the overall outcomes, and what would these model outputs, how can they be used, or how can they go wrong? If this narrative, if this discussion doesn't happen across the value chain, the model failure is going to be pointed out to a model developer who is in some corner, a statistician. But really he or she is not bringing the risk here. Does it make sense? I would like to be challenged on this.
But is it not important that model itself is sacrosanct actually? See, like if everyone start questioning about the model itself, then how it will work in the entire value chain? Like everyone is questioning it, and some very wise person in the boardroom has taken a decision, developed a model, and then when everyone is questioning it, how it will work like if everyone question the model?
Absolutely.
Like as you are saying, basically there can be certain stakeholders who should question those models, who should validate it. As Majumdar sir also said, like that when we are doing validation, probably at that point of time we are doing it. So I think that I don't know, like when we are talking about culture, how
it's a fair point, because if everybody starts questioning it, then people will stall the work and have coffee table conversations around models. It's a fair concern. But if on the other hand, flip it around and say that the model has been validated, and based on the tiering, it comes for validation once in 3 years. So I continue to use it, respect to the underlying changes in the scenarios in which this model should have worked. Nobody questions it, and we continue to use it. What will be the repercussions of that? The
people will be questioning it, but there will be people responsible who are responsible to keep a tab on the performance of the model. They only will be questioning it, not the entire value chain. Like, person sitting at branch using a credit underwriting, questioning a credit underwriting model. So that becomes very, very dangerous. Like he has to simply trust on that model, and then he has to work on it.
That's all I'm saying, sir. The moment we say it's trust and faith, then we are saying that I can simply close my eyes and use the output. The point that I'm trying to bring in, and why culture is important in this model risk management, is that be aware. The narrative that we want to tell the rest of the organization, even to the last mile in the branches, is this is a model which is designed to be a representation of the real world. This can fail too. Unless you keep your quote-unquote eyes and ears open, unless you are aware of the possibilities where it might not work, and you can give us that feedback, unless this happens, then the ownership, everybody else is driving the entire organization based on a few individuals and their ability to drive it. All I'm saying is it has to work in a feedback loop. Everybody has to be aware that possibilities of something going wrong, because the situations and the scenarios in which this model is going to get applied can change beyond what has been it's been modeled for. So we have a Deloitte risk maturity model. In that, the highest level of maturity really is being risk aware. Not that you will avoid, not that you will not have risk, but to be aware that there's a possibility that there is a risk, and therefore use discretion, or be in a position to use discretion to be able to underwrite that risk. So here again, the reason we brought up culture is largely because of this, because it is not just the model risk team, model development team that owns and runs the risk of models. People who challenge it, people who approve it, people who are providing the information that is going into the model, and people who are using it, all of them across the value chain, have some responsibility towards looking at whether or not this model works, whether or not we're using this model for the right purposes, whether or not the underlying scenarios and circumstances under which this model has been designed and developed and implemented, have they changed or not. And therefore, this is something that one might want to consider. And also, increasingly the ECL world, traceability and transparency of the models becomes critical. Would you agree? Have you already been dealing with those challenges with your auditors? Actually, possibly, I'm guessing that this room is split between CFOs and CRO organizations. How easy is it for the CFO organizations to understand what all complex models are being created? And if CFOs can please raise their hand, would you like these models to be complex or fairly straightforward in terms of explaining? Complex? Because it can look at every possible scenario that can happen, a macroeconomic outlay that looks at 7 different variables and a complex algorithm. Would CFOs prefer that? No? But that is a good estimation of what risks could look like. How many CROs and CRO organizations think that a model cannot be simplistic? A model will have to take into account every possible situation that can come up, and consequently is a representation of the real world. How many CRO organizations think that?
Is it possible to have all the scenarios worked into a model? I don't think it is possible. There are numerous scenarios
And
which
since
can
we can't, we just look at, baseline, maybe moderate and severe. But anyway, severe we leave it out. But we use some judgment to say what is a plausible scenario that can happen. But having said that, I think looking at just macroeconomic overlay for the next 12 months and the kind of variables that will be relevant for your portfolios and having a number of models, it is my best guess, and looking at having interacted with some of the CFOs, I presume that they'd like a minimum number of models, lesser complexity, something that can be traced back to the data that's being used, assumptions that, please do not make assumptions because these are very, very difficult to explain to the auditors. Please document everything that you think the model will do or will not do. This would be the ask of the CFO. Is that right?
Yes, ma'am. You are right in the sense I also want to make a point is that model should be able to comprehend all the maximum variables, but it should be easy to decipher so that we are able to, for the auditors and the person who are using it to work on it. But model inherent strength should be that n number of variables they should be able to compute.
And you summarize really the irony of this entire exercise, because on the one hand, reliability on the model outputs is an absolute need, and that can only be possible because if you are able to take as many scenarios as possible. But like someone said, you can't take all scenarios, and CFOs want predictability. That is a nice friction or healthy friction between the CFO and CRO organizations, which ECL guidelines anyway talk about it, that we have to work together. And what we've seen happen in the NBFC world is really this. CFOs want simplification, explainability. CRO world wants, because for the first time, I'll stick my neck out and say this. For the first time, after IRB went through its own rigmarole and highs and lows, after a long time, the CRO organization has budgets to now develop models, maintain models, model inventories, have teams, because it's so critical. Go ahead, have a field day, but now you can't come back and tell me limit the number of models. Here I am waiting for an opportunity like this to kind of use my intellect to kind of create the most complex. As CROs, quant people, this is your field day, isn't it? But the CFO is reining you back, and that's the friction.
The CFOs have got profit target. That predictability is affected by the model. So that conflict will continue.
The reason simply is this, right? They have to face off with the auditors. They have to face off with the auditors, and if explain, yes, sir, please.
Always rely on our numbers.
No, of course. Auditors can in the short time that they have, auditors they're not going to do full validation for sure. They are going to test check for the numbers. At that time, if they, God forbid, if they use a challenger model, because they'll get to another result totally, they will start asking for explainability of the model. When we do that, we're talking about model documentation, the completeness and coverage of the model documentation, the kind of algorithm they will start asking, and because we've done that too, right? So we say, why do you take only 5 years of data when you had 10 years of data? Are you doing cherry picking? Are you cutting out some data which is not appropriate? Why did you use this choice of model as opposed to many other choices that you might have? So the responses, the discussion and the dialogue with the auditor is going to be that of explaining yourself as to why you've not taken a course of action which is many options, but you've chosen to do this path.
That question should arise only when there is a significant divergence between the two numbers, right? It should not happen that auditors are not doing their job and they are challenging my models that, okay, your models, explain me the model. You have to do your job first and then come with the questions.
All I'm saying is when you use ECL-based estimates, the first thing they'll want to understand is how did we come up with these estimates? How much data have you used? Which algorithm have you used? What assumptions have you made, right? Have you changed it during the course of this? These are questions that an auditor will ask, because anything to do with estimation, they will want to ask these questions. in trying to get the responses and satisfying themselves, they would want to ensure that they have done a decent job, a good job of sufficiently challenging the management on the various pathways that they could have potentially taken. In that bid, the CFO is facing off with them. The CFO is now trying to explain in a model what are the assumptions that have not been documented but exist. What are the limitations that do not get documented but exist? Why we have chosen a certain algorithm vis-a-vis another one? Why we have taken 5 years of information for a certain portfolio but 7 years of information for another portfolio? Why LGD should only be 5 years and not 15 years? These are questions that the CFO is not, don't kill me for this, is not trained to answer. Now, as CRO organization, your first job is to explain to your CFO. When I say CFO organization, together explain to the auditor. Now, this is not the end of the road either, right? Because then comes the whole investor community that's going to keep asking questions around why you've taken a certain estimate, a certain level of PD and LGD. Questioning not just the numbers and the veracity of those models, but questioning the adequacy of governance and internal controls. So what is the kind of posturing that you would want to do in your disclosures? That is acceptable. That is possibly, dare I say, defendable. So it is, while on one hand, here is where the CROs, CRO organizations, can have a field day with the kind of complex models that you can create, and a CFO who is dreading the lack of predictability in the modeled output. For the first time, provisions cannot be modeled, and it's not just explainability to the auditors, also in their own capital management planning, business planning. This friction, somebody talked about implementation and preparedness. This regulation has been in the coming for like 6 years now, or more. The preparedness is not to do with models. We always get the brass tacks right. It's about how to make it work is where the preparedness really lies. Like I said, this session was only going to be about questions and questions. Rather than you ask me questions, I'll do that bit. Some of you have also have had exposure to what is happening in the NBFCs as well. Any views on how NBFCs are looking at complexity of models? On a scale of 1 to 10 or 1 to 5, do you rate your own models complex? Five being the highest complexity. And let's limit this conversation only to ECL because we have enough experience of working with ECL models. Are your models complex, ECL models, macroeconomic? Are they judgmental? Judgmental? All statistical? Sorry?
Mostly judgmental. I think macroeconomic modeling, whatever I've seen, you don't get statistically
significant.
results.
Yeah.
Or sound results which continue to kind of work over time.
Continue to ensure there's no volatility in the outputs.
Volatility will be there. I believe that ECL by definition will lead to some volatility in P&L. That cannot be avoided. But I was coming more from the perspective that if you build a macroeconomic model, a statistical model, it is unlikely you will get a model which will keep working year on year. Whereas most of your IRB kind of models, if you are predicting a particular level of PD within a statistical significance, you will expect the output year on year.
So you're saying, having tested for a whole bunch of things, you kind of leaning towards judgmental models, particularly on the macroeconomic. Okay? But the PD, LGD, AD conversations are purely statistical. Is it?
CRO team. So it has to be complex actually. And otherwise also say PD, LGD, EAD, like all those new concepts, like if statistics is not involved, you can arrive at a number. So basic the model will be complex. In
Sure.
most of the cases, except for the one who has developed it. He only will be understanding it. For everyone else, it will be certainly complex.
For NBFC, whatever you said, no, I think their CRO, CFO, there is no conflict because after implementation of ECL there, we are finding the average provision coverage ratio is around 50%, which is half of the PSU bank's average PCR. So with that, if there is no conflict, so we can only assume that yes, things are good there.
The reason I ask this question is complexity for complexity's sake, or do you see, what has happened over a period of time as you go over the curve, you actually see that models go back to, they tend to explainability, simplicity, and being able to validate them for the outcomes and fit for purpose. They tend to go down that path. Are models built for black swan? Are stress testing models built for black swan events? Should we? No, agreed, but should we build for a day and age of black swan? Extreme events. Should models be able to give us the extreme event outputs? Okay, so we don't have to. So what is plausible then? Particularly in the stress testing, this becomes a critical area. The other thing also is backtesting. If you're trying to look at extreme values, also is going to be challenging. One other thing is, I think the focus of the regulators, in at least the global ones, has been around the portfolios which are fairly difficult to model. And I'd assume that this is what's going to happen for us as well, based on methodologies that you're going to be looking at for low default portfolios where you might have experienced, even from LGD, forward-looking LGD kind of terminologies, that one is going to really question how have you approached them, what is the reliability, and more importantly, I think, I think I should have mentioned this, comparability. As you start disclosing your own ECL outputs, your own, in the disclosures, comparability is going to be one question that's going to come up. So why is the choice of models for a certain bank, peer bank, vis-a-vis another bank, why is that different? Why are the estimates different? This is something that the NBFCs have gone through the cycle and are definitely one of the things that they're on the street, the question focus really is, why is the PD LGD of a particular portfolio, not even at enterprise level, of a certain segment, why is that different from ours? What is the methodological choices that they're using? These are all questions that will come up. And therefore, it is not just what we can do, it is also having an eye on what the others are able to do as well. I'm not going to talk about data, much beaten down and much challenging. I think all of us understand the issues around this. A word on AI and ML models. Almost all organizations have started using or have a pipeline to develop and start using ML models. The model validation techniques, the underlying infrastructure required both for development and validation, and the governance mechanisms that are required, all of them are going to be different. And if you're going to be using an external vendor to be able to develop this or host on an external vendor's platform, again, your model risk management framework will have to address all of these components. Let me just get to this first. We alluded to tiering, and I want to highlight this for a little bit. If we define a model, we look at garnering anything, we do a massive drive to understand what are models and get everybody to identify the models that they use, and therefore create an inventory of models. What happens next? Assume you have model validator teams are about 5 to 8 and you have to validate 300 models in a year, or maybe based on whatever frequency you want to. And this does not include all the committee meetings. It does not include monitoring activities. 300 models, 5 to 8 people. The world regulators, everybody has shown us that the risk-based approach of looking at things is better. So tiering concept comes in. So you tier the models based on what is the most important impact that they carry when you use these models. And by that I mean anything that is to do with the regulator takes primacy. Anything to do with estimation that is going to cause P&L impact, anything that is going to cause risk-related issues either at a point in time or over a period of time take primacy. Business growth, if you ask a first line, business growth might be important. But from an impact standpoint, in the 300 odd models that you will have across the organization, you will look at business from a materiality standpoint. You look at business models from whether or not, based on your span of control, whether or not you control them, you own them, they are housed, developed, managed by you, or they're developed, managed, housed elsewhere. That is another criteria that you're going to use to see whether or not you would want to tier them at a higher level. So there is simply to say that you would want to look at tiering. You can use any lens for tiering. Materiality of business comes in, regulatory considerations come in, risk considerations come in, and whether or not you're able to control that model comes in. Once you have that, you're able to tier whether you do it 3 levels, 5 levels, 10 levels is your organization's choice. But the purpose of tiering is so that the more important ones have sufficient attention from you, from the governance angle, from the board, etc. You have sufficient resources to be able to ensure robustness of these models. And progressively, you might also say the rigor of testing and validation progressively goes down. Sometimes you might want to test the model once in 3 years, which is acceptable. So for us, I think you can talk about model health, model validation in metrics, etc. But largely, once my earnest request is please go back and look at the definition of models that you're currently using, because that can lead to a runaway number of models that you might be considering in your portfolio of models to validate. Second, inventorize them, categorize them. Once you categorize them, you will be able to tier them, have a tiering framework, you'll be able to tier them. The reason this is necessary is that you are focusing on the more important ones and you are allocating sufficient resources for this. Governance of algorithm basis some statistical tests, you can say whether or not you can use them or not. And all of us agreed that models do not work in every situation. They're not intended to work in every situation. But at least for the purposes that they've been designed for, the role of governance is to really ask, what is that purpose? Under what scenarios will it work? Under what scenarios will it not work? Challenge the algorithm, challenge the data, ensure that the data is traceable. That is the role of governance. Ensure that everything that is discussed, that is deliberated, the philosophy of it, all of it is documented appropriately, because this is going to be up for rigor of testing by external people as well. Last, I'd conclude by saying that when you develop a model and put it to use, if people who use it do not understand that model, do not either place over-reliance or start doubting, we are somewhere in between. We're not doubting it, we are only asking the right questions. If you don't do that, what you might end up is I'm calling it a black box syndrome. Only a handful of people can explain it all, but for the rest of the organization, it's a black box, and that doesn't work well. So with this, if you have any questions, happy to get challenged on any of the things I said. We spoke briefly about the healthy friction between CFO, CRO organizations in trying to figure out what is the complexity in the coverage of models. We'll only see that it will play out And hopefully some of these conversations you'll recall as they play out. Yes, please.
We'll be able to take only one question given the paucity of time, and the rest we can discuss over lunch. Hope that's fine with you, ma'am, too. Yeah. So we can take one question. Please raise your hand.
Hi. So given your experience with NBFCs on ECL models, what are the top 3 takeaways which you'd like to share with us?
Experience of ECL models, top 3 takeaways with NBFCs? Okay, sure. The first is over-segmentation. Because you would want to see the risk homogeneity, they started off with a number of segments, and when you apply macroeconomic model on that, the variability in the way the ODRs were playing out to what the models were predicting were out of whack. First learning. Second learning is I have all the data, and NBFCs have had the luxury of this, right? So I have 10 years of data, 12 years of data. So why can't I use all of it? Our own banking has been driven by that 5 years somehow, isn't it? That's been etched in our memory because of the IRB guidelines. So anything more than 5, we start questioning. But what I've seen, and it's a fascinating thing, is that fairly regularly, they take 10 years. And our question or challenge on that is really, if it is a business cycle, if really you're able to see that this is covering a business cycle, maybe it might make sense. Otherwise, just availability of data does not make any sense. The third, what I spoke about in terms of the friction really played out. In organizations which had very strong, NBFCs, some large NBFCs do have very strong analytics teams. The nature of complexity that was created for refresh of the model possibly every 3 months and the number of models, to what in certain organizations, the CFO was driving the development of the models also. So the outcomes, there was no convergence on those. So you will actually found that of late, it's the risk officers who are developing the models and CFOs who are really working with them to understand and use those outputs. But otherwise, what we've seen is that depending on where the gravitas was in the organization, they started running away with development of these. And it's only now the semblance is coming. Those are possibly some. Of course, the SSCR criteria, the complexity of SSCR criteria, modeling all of that, those remain. But I think there, again, simplifying those rules help them. Their focus is on optimization of provisions for some really good reason.
Thank you.
Thank you very much for the comprehensive presentation and for making it quite interactive as well. May I request Shri Gopal Murli Bhagat, Deputy Chief Executive IBA, to kindly come up on the stage and present a memento to ma'am as a token of our gratitude. Thank you, sir. Thank you, ma'am. We've been receiving many messages for the PPT. We'll be sharing the PPTs later with all of you. So thank you for the engaging discussion, everyone. We'll now break for lunch and we'll be back in 45 minutes, please, so that we can continue over the further discussions. Thank you very much. By 2:15, we shall be back, please. Thank you.